You inherited an IRA. Here's what the IRS says you must do next. Imagine you just inherited a $200,000 IRA from a parent. You're grieving. A financial advisor tells you, don't worry, just leave it invested, let it grow, and take the money out in year 10. Sounds reasonable, except here's the problem. Depending on when your parent passed away and whether they had already started taking distributions, you may be legally required to take money out every single year, not just at year 10, and if you missed those annual withdrawals, the IRS charges a 25% penalty on every dollar you should have taken. And here's the other trap. If you wait until year 10 and take the entire $200,000 at once, you could be paying nearly $80,000 in federal taxes on that inheritance. Spread it over 10 years instead, and you might cut that bill in half. The rules around inherited IRAs changed dramatically in 2020 and then changed again in 2024. Most people who inherit an IRA, and most financial advisors, still don't fully understand what the IRS now requires. In this video, we're going to break down exactly who the 10-year rule applies to, what the annual RMD twist is that almost nobody talks about, how to legally minimize the taxes on an inherited IRA, and the 5 mistakes that cost beneficiaries tens of thousands of dollars. Let's get into it. Let's start with the most important question. Does the 10-year rule even apply to you? The IRS divides inherited IRA beneficiaries into 2 categories. The first group is called eligible designated beneficiaries, or EDBs. These are beneficiaries who are completely exempt from the 10-year rule. This group includes surviving spouses, minor children of the deceased, though their clock starts when they reach majority, disabled or chronically ill individuals, and anyone who is not more than 10 years younger than the person who died. If you're in this group, you have different options. Surviving spouses in particular have the most flexibility. We'll come back to them in a moment. The second group, which covers the vast majority of people watching this, is non-eligible designated beneficiaries, or NEDBs. This includes adult children of the deceased, grandchildren, siblings, non-spouse partners, and most trusts and estates. If you inherited an IRA from a parent, a grandparent, or a sibling, you are almost certainly in this group. Here's what the 10-year rule means for you. The entire inherited IRA balance must be withdrawn by December 31st of the 10th year following the year of the original owner's death. So if your parent passed away in June of 2024, all of the money must be out of the account by December 31st, 2034. No exceptions for market downturns, no extensions. That is the hard deadline. But here's where it gets more complicated. The 10-year rule doesn't necessarily mean you can just leave everything untouched for 9 years and take it all out in year 10. That depends on one critical question, and it's the part most people don't know about. This is the section that most videos get wrong or skip entirely. So pay attention here. The required beginning date, or RBD, is the IRS deadline by which every traditional IRA owner must start taking required minimum distributions. Under the current rules following Secure 2.0, that date is April 1st of the year after the owner turns 73. Here's why this matters for you as a beneficiary. This was a huge point of confusion for several years after the Secure Act passed. The IRS kept delaying enforcement while they finalized the rules. As of 2025, it is now fully in effect. If you inherited an IRA from someone who had already started taking RMDs and you haven't been taking annual distributions, you need to talk to a tax professional immediately. Now let's talk about the part that affects everyone in both scenarios, the tax math. Why withdrawal timing matters enormously. Inherited traditional IRAs, and I want to be clear, this is traditional IRAs, not Roth, are fully taxable as ordinary income. Every dollar you withdraw goes straight onto your tax return in the year you take it. Let me give you a real example. Suppose you're a 45-year-old professional earning $100,000 a year and you inherit a $500,000 traditional IRA, same inheritance, same IRA, difference in federal taxes, $65,000 to $75,000. Withdrawal timing is one of the most powerful levers available to an inherited IRA beneficiary, and most people don't think about it until year 9. Let's walk through the 5 mistakes that cost inherited IRA beneficiaries the most money and what to do instead. Here's how to think about strategy for an inherited IRA. Here's the bottom line. Inheriting an IRA is not just about receiving money. It's about making decisions under IRS rules that most people don't know exist until it's too late. Know your beneficiary category. Know whether the original owner had started RMDs, and plan your withdrawal strategy in year 1, not year 9. The difference between a smart inherited IRA strategy and a bad one isn't about investments, it's about tax planning, and that gap can be worth $50,000 to $100,000 on a single account. If this video helped you understand the rules, drop a comment below. I'd especially love to hear if you're currently navigating an inherited IRA and what your biggest question is. And if you want more plain English breakdowns of tax and retirement rules that directly affect your money, hit subscribe. New video every week. This video is for educational purposes only and does not constitute financial advice. Always consult a licensed financial advisor or CPA before making decisions about an inherited IRA.